The banking industry is a complex web of financial institutions, regulations, and practices that can have far-reaching consequences on the economy and everyday people. One of the most significant aspects of the banking industry is how it operates in the mortgage market and its relationship with taxpayers' money. Here, we'll delve into some key factors that illustrate the banking industry's role in our financial landscape. The mortgage industry's interest game. When you take out a mortgage, you might not realize that for the initial years, a significant portion of your payments goes toward interest rather than paying down the principal amount. This can be frustrating for homeowners who wish to build equity quickly. However, it's a standard practice in the industry and a source of substantial profit for banks. The result is that borrowers end up paying more than the original house price over the life of a loan. Bank bailouts and taxpayer dollars. The financial crisis of 2008 exposed some deep-rooted issues within the banking industry. When major banks faltered and faced potential collapse, they were bailed out with taxpayer dollars. This meant that not only did banks profit from mortgage interest payments, but they also retained their assets and received a financial lifeline from the government. It often felt like a triple win for the banks, leaving taxpayers to bear the burden. Inflation's impact on home prices. Inflation plays a crucial role in the real estate market, affecting how homes are priced. Typically, when inflation is high, real estate prices tend to be listed lower. This might seem counterintuitive, but it's linked to interest payments on mortgages. With high inflation, the real value of these payments diminishes over time, which allows homeowners to list their homes at more affordable prices. This phenomenon can affect different types of mortgages, whether they are 20-year or 30-year notes. Historical struggles and financial system restructuring. Throughout history, there have been instances when a flawed banking system required restructuring. The Great Depression of the 1930s prompted significant financial reforms, including the Glass-Steagall Act, which separated commercial and investment banking to prevent risky practices. The 2008 financial crisis led to the Dodd-Frank Wall Street Reform and Consumer Protection Act, aiming to enhance financial stability and protect consumers. The fractured banking system, an in-depth look. The fractured banking system is an essential yet often misunderstood aspect of modern finance. This system has a profound impact on how banks operate, how they handle customers' deposits, and ultimately how the economy functions. Let's take an in-depth look at this concept and understand how it works. Fractional reserve banking, the foundation. At the heart of the fractured banking system lies the concept of fractional reserve banking. This system allows banks to operate profitably by lending out a significant portion of the deposits they receive. When you deposit money in your savings or checking account, the bank doesn't simply keep all of it in a vault. Instead, they use a fraction of those funds to extend loans to other customers, whether it's for mortgages, business loans, or personal loans. The money multiplier effect. Fractional reserve banking works on the principle of the money multiplier effect. For every dollar you deposit, the bank is allowed to lend out a certain percentage of that dollar. The exact percentage varies depending on regulations and central bank policies, but it's typically around 90%. This means that for every $1 you deposit, the bank can lend out 90 cents. Creating money out of thin air. This process can seem somewhat paradoxical because it effectively creates money out of thin air. When the bank lends out 90 cents of your $1 deposit, it doesn't physically have 90 cents in reserves to cover that loan. Instead, it relies on the assumption that not everyone will come to withdraw their deposits simultaneously. This is where the term fractional reserve comes into play. How it benefits the economy. Fractional reserve banking serves as an essential component of economic growth. By lending out deposited funds, banks can fuel economic activity and stimulate investment. It allows businesses to secure capital for expansion, individuals to finance homes and education, and overall contributes to economic development. Risks and challenges. While fractional reserve banking has its advantages, it's not without risks. One major concern is the potential for bank runs. If too many depositors simultaneously request their funds, banks may not have enough reserves to cover these withdrawals, leading to financial crises. Central bank oversight. Central banks, such as the Federal Reserve in the United States, play a crucial role in regulating the fractured banking system. They establish reserve requirements, which dictate how much money banks must keep in reserve compared to their total deposits and outstanding loans. By adjusting these requirements, central banks can influence the money supply and, in turn, the broader economy. Recent developments. In recent years, advancements in technology have introduced new dynamics to the fractured banking system. The rise of digital banking and cryptocurrencies has challenged traditional banking models, potentially reshaping the financial landscape. Central bank digital currencies, CBDCs, are also on the horizon, which could impact the way money is created and managed in the future. In conclusion, the fractured banking system, built on the foundation of fractional reserve banking, is a complex but vital part of our modern financial world. While it comes with risks, it plays a crucial role in economic growth and development. Understanding how it works can help individuals make informed financial decisions and contribute to discussions about the evolving nature of banking in the digital age.